The views and opinions expressed on this program are not necessarily those of this station, JVC Broadcasting Management, or its sponsors.
With so many people living longer, the fear of outliving your money becomes a reality for many of us. Will I be a financial burden? Will I outlive my money? How will I be remembered? My name is Neil Himmelstein, president of Main Street Planning Group. Please contact me by visiting mainstreetplanninggroup.com. That's mainstreetplanninggroup.com, or call 631-647-4694. I will introduce you to strategies that will guarantee you will not outlive your money, that can guarantee you will not be a burden on your loved ones. Through a collaborative approach, we will uncover solutions that offer tax-efficient strategies, lifetime income, and legacy planning, choice, organization, direction, and education. That is the code we stand behind. Contact mainstreetplanninggroup.com, that's mainstreetplanninggroup.com, or call 631-647-4694. And listen to me every Friday at 3 p.m. as I host the Main Street Code for Financial Success, right here on 103.9 LI News Radio. Good afternoon. Welcome to the Main Street Code for Financial Success. I'm your host, Neil Himmelstein. I'm here every Friday at 3 o'clock. And if you happen to miss an episode, you could check out my website at themainstreetcode.com, where I have YouTube videos. Or if you're driving around and got nothing to listen to, go to Apple or Spotify, and you can take my past episodes and pick them up on your podcast. When we talk about our code, we talk about choice, organization, direction, and education. And we help hundreds of advisors across the United States, attorneys, CPAs, CFPs, insurance professionals, with all kinds of insurance needs. We are specialists in life insurance, disability, long-term care and annuities, and do a lot of high-end planning with estate planning, business continuation planning, buy-sell agreements, all these good things that's our areas of expertise. And today I just want to talk to you about this organization I founded, which is called LIAFPN, Long Island Accounting and Financial Planning Network. And I founded it really in 2017 with an estate planning attorney with the goal in mind of having a think tank to help our clients best, to have the best attorneys, the best accountants, the best financial advisors on hand for any questions or any things that you need. You need a team when you're working with people. So if you need a team of professionals, not just one, you want to have specialists in all the areas, but they're all working in the same direction, and you don't have a team, let us help you put one together. It's something we do on a regular basis. And this week we had a nice breakfast meeting where we talked about taxes. We talked about the Democratic proposals and the Republican proposals, if one got in office and the other got in office, and how it relates to you. And I thought it was a great discussion when we had this nice cross ventilation of ideas and concepts from the attorneys. The CFPs were there. We had a couple of accountants there that all had their say. And, one thing is the world's not falling, okay? It's not coming to an end if one wins or the other wins. It's always, Congress really gets involved in any type of tax changes. There are some major laws sunsetting in 2025. The whole Tax Cut Act is sunsetting. And that affects the corporate tax rate. It affects the state tax rate, which is currently at 13 point something per person, which will automatically go down when it sunsets to $6 million per person. So that makes a big difference in planning for people that maybe aren't quite super wealthy, but now all of a sudden may fall in that bracket. So there's a lot of changes, with corporate tax, if they go up or down, what that could do to the Long Island economy, to companies that may want to work overseas. Higher corporate tax may force them out of Long Island. So these are things that are under consideration and were discussed. What I found very interesting in this whole discussion about all these different things is the lack of planning that I'm finding many of these CFPs have. Not everybody, but, I'm not being critical of CFPs. They go through extra education to be certified financial planners, and I know lots of them. But most of them have gravitated toward managing money. And that's all well and good, but they don't talk about the next generation necessarily or distribution of money. So money is a multi-generational thing when we're talking legacy. And I find the attorneys also, if they're a good estate attorney, they're going to talk about the next generations and how to protect your assets, while you're living, but good ones will also talk about what happens if next generation. But one of the most overlooked things, and I've said this on many shows, is that these CFPs that are managing money and managing 401ks and doing all this money management, and you're accumulating all these assets, the government has already put something into effect that when you distribute them, they're taxable. Okay, so they're allowing you to accumulate them till older ages. You don't have to take withdrawals. It used to be 70 and a half. Now it's 72 from your what we call qualified money. That's your IRAs, your 401ks, your 457s. All that money you were able to deduct from your taxes, defer the interest until you have to pay tax on it. So they have allowed it for longer, but that just means that you accumulate more, and then it forces you, when you take that money, to be very cognizant of what your taxes are, because they're going to force you to take money, and that alone may drive you in a higher tax bracket. So we talk about intergenerational planning, and if you leave it behind, you can be a tax burden to your children or your spouse or somebody else. So I mentioned this in past episodes, but there's a new rule that happened with Secure 2.0. It's not new anymore. It's about 2 or 3 years old. That if you inherit an IRA or you inherit a 401k or you put the beneficiary down as your child or your uncle or your cousin or your brother, you can basically hurt them from a tax standpoint. Because whatever money is left behind in that vein has to be left behind in 10 years. So let's say I had an 18-year-old and I left him $100,000 or $500,000 as part of my IRA. Who's managing that money when they have to take it out for 10 years? Are they financially educated enough to handle that kind of money? And that money is forced to them. Now, it also affects their tax bracket. So maybe they're in a 15% tax bracket. All of a sudden, that money becomes 100% taxable to them every year they take it. So you may have thought you left $100,000 to your child. Aren't you wonderful? But by the time they pay taxes on it, it's maybe worth $50,000. You've already eliminated this wonderful thing that you wanted to leave behind to your child. Now, you could leave behind, and a lot of people say, well, that's what I'm going to leave behind. But that's the wrong asset to leave behind, because that's the most taxable. It's also estate taxable if you fall into this estate tax world. So you could almost, if you've done very well, you're a doctor or whatever, you've accumulated a lot of money in your IRA, let's say $1 million, and you left it to your child, and they have to take out $100,000 a year, it could also be subject to estate taxes, which they're trying to lower all the way down to $3.5 million, possibly. The Democrats, they're pushing because they want that money. So it could be estate taxable, and then when the beneficiary receives it, income taxable. Now, a lot of people aren't concerned because they're leaving it to their spouse. So they're going to leave their spouse a big IRA, but again, that could affect their tax situation. And God forbid you leave it to a son or a daughter or someone who's mentally or physically disabled that's on government programs. By giving them that money, you have officially kicked them off of all programs, because now they have income. So now they can't get government assistance to take care of them, and anybody who has an autistic child or is taking care of a brother or a sister or a loved one, and you want them to have something, you need to do planning. So leaving them your IRA is a horrendous situation. The best way to leave them money is inside special needs trusts, or life insurance is estate and income tax free to them. So a lot of what we teach is, hey, I know I have to spend this asset. If this is what I'm going to leave behind, why don't I leave behind my good assets, life insurance, other things, house, whatever, but that IRA and stuff, why don't I leave it to charity? There's no taxes there. And then leave them life insurance, and you could take some money out of your IRA to pay for that. You're listening to the Main Street Code for Financial Success. I'm your host, Neil Himmelstein. I can be reached at 631-647-4694 or themainstreetcode.com. We welcome your comments and questions and look forward to coming right back after this commercial. To the Main Street Code for Financial Success. I'm your host, Neil Himmelstein, and I can be reached at 631-647-4694. And before the break, we were talking about an organization I founded called the Long Island Accounting and Financial Planning Network, LIAFPN, and we have monthly meetings where we discuss topics that relate to you. And what I'd like to do is, it's a think tank for all our clients' benefits to really discuss the issues of the time, whether it's taxes, insurance, and I was really amiss when we had our last meeting because I had a bunch of CFPs in the room and a bunch of accountants in the room, and all they're thinking about is the taxes, and nobody's thinking about how do I protect my loved ones and the next generation. And that's where insurance comes in. That's the essence of life insurance. And it's not a matter of a cost. A lot of times it's reallocating your assets. It's looking at your IRA and saying, I'm not going to use all this money, and this is designed for my retirement, and your accountants have recommended, your CFPs had recommended, just pour money into your 401k and IRA. This is great tax savings. But when it's time to take it, and you have enough other assets that you're living on, and you keep deferring this asset, at some point you have to take it. But it's a horrible asset to leave behind, so why not take a piece of it and insure it with life insurance and make it tax-free to your heirs and leave them the good stuff. Leave the charities the stuff that's going to be overly taxed. It's not going to be taxed to you. Leave your heirs the good stuff that you want to leave them. And if you're charitably inclined, you can make a nice charitable donation without having to make it with something that you already have. So utilize that asset, and whatever you don't utilize, give it to charity if you like, if you're so charitably inclined. I think it's an idea. Not every idea is for everybody. The other thing we face when we, even prior to retirement, there's protections that we have to have that maybe your attorney's not talking about, maybe your investment people aren't talking about, maybe your insurance people aren't talking about it. And if they're not talking about it, you're not talking to the wrong people, because there's two things that can happen. There's many things that can happen along the way. One is we could become disabled. And, it's not always from an injury. There's so many people I know have cancer, or they can't go back to work, or this happens or that happens. We hit bumps in the road. GI problems, colitis, all kinds of different issues happen to people along the road, injuries, sicknesses, and we fail to protect our income. What if we become disabled? You need paycheck insurance. It's called disability insurance. And the thing, if you're working for somebody, the obvious answer is, oh, I got it at work. Well, what do you have at work? Do you really know? Have you ever looked at your benefits? Have you ever seen, the thing at work is you may have it. It may not be enough to support your family. It probably isn't. And what do you really have? And if you leave your job, do you have it anymore? No, you don't. So if you have to leave your job, or you get fired, or you quit, all of a sudden you don't have that protection. And then what happens if you get sick? Now you're up poop street. Really. You're in a bad situation. So disability is really crucial. That is the most crucial coverage you can get to protect your paycheck while you're working. There's nothing else protecting your paycheck but a disability income. And it has saved lives, because if you're depending on that paycheck to live, as we mostly do, you have to insure it. Even if you're self-employed, especially if you're self-employed, if you're a doctor, you're a lawyer, you're an accountant, you're a plumber, you're an electrician, you got to protect your income from becoming disabled. And then as we do our planning and we look at your insurance and your disability insurance, we also have to consider long-term care coverage. Now, long-term care coverage is vital. And it doesn't have to do with work, it has to do with performing my daily activities of living. So you can have both disability and long-term care insurance. Typically, most people start looking at long-term care insurance in their 50s or 60s or 70s. But, it's not something wrong to think about in your 40s and take care of it and make sure that you have it, especially if you start seeing your parents and your grandparents needing significant care where you have to take care of them, or you can see what it's doing to your parents or your grandparents and their assets, and not only their assets, their mental and physical health that you have to help them with, and whether you have to help them get groceries or pick them out of a chair, or, that's what long-term care is all about, and it does happen. It's happening more and more. Over 70% of us are going to need some sort of long-term care. 70%. That's more than 2 out of 3. The other 30% are taking care of the 70% and paying for it. So, yes, you got to insure yourself and your spouse. Very important for your independence and theirs. There's a lot of different ways of buying long-term care these days. It has evolved into, you can do a combination with your life insurance planning. You can buy long-term care. You can do it as a big asset. You have, instead of a CD, you could buy long-term care. It'll have life insurance and let you return the money and give you a little return. Or you could buy a traditional long-term care plan or a traditional disability plan. These are the important parts of planning, and they all coincide. Now, I get this every day of the week, twice on Sunday. I'm all covered. I got everything. I'm all covered. Oh, yeah, everything's good. You know what? I can't tell you how many times a day I get a call that somebody passed and they don't have a copy of their policy and they need to do a death benefit claim. Well, first off, if you bought from the internet or you bought from Mickey Mouse, you're not going to find anybody to help you. So you'll reach out to the company and you'll go through an 800 number and you'll sit online for 40 minutes and get frustrated and spend hours and hours and hours trying to figure this out. Okay, that's a problem. If you buy a policy through myself or a qualified agent who sticks with you and who's really good, they're going to take you through, help you through the process. A. B is 90% of the people I know don't keep a copy of their policy, or after they're gone, they haven't told anybody where it is. So on that policy is a beneficiary or beneficiaries. And if that beneficiary changed over time and the insurance company only has that beneficiary, that's who gets paid. Period, end of story. It doesn't matter what your will says, doesn't matter what your trust says, that's who gets paid. We just had a recent situation this week where someone had moved their they had Lou Gehrig's disease and they were in bad shape, and the advisor made sure that they moved it into a life insurance trust, and a life insurance trust is the beneficiary. There is a little rule that there's a 3-year look back where you couldn't avoid the taxation of this. It's still going to be part of their estate, but had they done it 3 years sooner, then it wouldn't be part of their estate. It would be inside a trust. The trust is still the beneficiary because that's the named beneficiary on the policy, but that'll all be figured out. All I'm saying is it goes by beneficiary. Even if you have done great planning and you have a trust and the trust owns it, but you have Mary and Joe as the beneficiaries, guess what? That money's not protected. That money goes to Mary and Joe and is subject to estate tax. It's not about ownership, it's about who the beneficiary is. And people don't understand that. And attorneys might set up these great trusts, but if they're not put together right, if the policy's not doing right, you need to have it reviewed. The net of my conversation is your policies, like everything else, like your investments, should be reviewed either semi-annually or annually, and they should be looked at by a professional and make sure everything's running the way you want it to be, because after you're gone, you could do nothing about it. Thank you, everyone. You've been listening to the Main Street Code for Financial Success. I can be reached at 631-647-4694 or visit me at themainstreetcode.com. Thanks. Have a wonderful weekend.
The views and opinions expressed on this program are not necessarily those of the